Let's dissect this report. And I'm being joined by a renowned economist, of course, development economist, and he's Professor Ken Ife. He's also a London Expertise Ambassador and holds several other international appointments. I can go on and on, but let's talk to Prof. Prof, thank you so much. It's good to have you start the week on Business Nigeria.
Oh, thank you for having me.
Nigeria's developmental updates is the title of this report from the World Bank. And they say Nigeria stands at a critical junction to make some decisions. What do you make of that report in its entirety before we go into some specifics?
It's a brilliant report, actually. And I've gone through it, and virtually most of the things he says are absolutely correct. And I think we need to pay heed to what they have to say.
So you agree with that? Well, let's start with issues around macroeconomic stability and policy predictability. A lot has been said around these issues around FX and all of that, debarring investors from coming into the country. Do you see all of this being resolved in a short while?
I'm not sure they will all be resolved in a short while because some of the issues that are fueling the instability are still here. So many dimensions of the instability. You have very high poverty, you have high unemployment, you have issues around investment vaporizing away, both FDI and foreign portfolio investment. Then you have high costs that are driving inflation. And when you look at some of those headlines, you find that some of the underlying factors are still there. For example, we are getting very high prices of crude, but we're not taking advantage of it because we have low production volumes. And so it comes back, because if you can't have a commensurate production volume of 2 million or 1.8 to guarantee decent revenue, then you will be snowed under by your rising cost profiles. And of course, you have debt profile that is rising tremendously. And it's getting very difficult now. Then, of course, you now see what NNPC has also done to the system, because NNPC is supposed to be bringing in about $3 billion every month to central bank as proceed from crude. For the whole of last year, it wasn't bringing any. Now it's only about 10%, 300 million. And then CBN needs to spend $1.8 billion a month. Can you now imagine you are getting only 300 and you have to spend 1.8 billion, and then the import bill is $4.6 billion. So it's a very tough thing to do, and CBN can't print dollars. So, you've got a very tough, and the arrears are mounting on the debt. The debt is increasing. We are still getting more foreign denominated loan, dollar denominated loan, and then the cost of servicing these loans are becoming excruciating. So yes, we have those instability factors. We have flood that has also complicated our problem on the food, because over 200,000 hectares went under flood, underwater. So again, pushing the prices of grains in the marketplace. So all of those underlying factors, and even the structural factors, the cost of petrol and diesel rising 400%, pushing the input cost, they're not going away. Those things are not going away in the next few months. It will still take some time for them to stabilize.
Prof, let's talk about structural issues now, particularly job creation. The World Bank is saying the process seems to be slow. What would you say are the positives of all of the initiatives that have been introduced by this government to address this ugly trend, unemployment?
No, the thing is this, bearing the structural factors that I have just mentioned, insecurity is actually one prominent one, because insecurity knocks confidence off from investors who want to invest. And investment is very central. You have to invest or give the private sector the confidence and the security for them to invest. Yes. And when they invest, then it creates economic activities. And it's those activities that create jobs. Jobs give you disposable income. From those disposable income, you can now pay for your health, your education, and poverty reduction. You've got to get that cycle. If you are not following that cycle, then it means that you are going to be robbing Peter to pay Paul, or you are going to be borrowing to share. And then that's where the tragedy will come, because how long will you continue to borrow? And if you are sharing, you are not producing. And if you're not producing, it becomes cyclical poverty that you are going to end up with. So the government has been trying in some respect. For example, there are strategic revenue growth initiatives by the Federal Ministry of Finance, which has used the instrument of Finance Act of 2019, 2020, 2021 to continue to put pressure on reforms. And those reforms are to push our revenue from 7% of GDP to 15% of GDP, literally doubling that revenue base, because that revenue base means you have enough cash to repay for the debt service. So we have been low, the lowest in Africa actually. And then there are other areas that they need to touch, like in VAT, they've been recommended to push it up a bit. But in all of these permutations, the excruciating pain comes from NNPC asking us to go and borrow 500 billion every month for subsidy. And that is just not acceptable. And we can't live with that for too long.
The oil and gas space, Prof, I don't know if we should stay there a bit before we move on, but there are opportunities in gas. We've been talking about this. Are we ready to take advantage of this and start to get revenue from this? We have proven and unproven reserves. Why are we so fixated on proceeds from oil? When are we going to get into getting more from gas? We say it's a decade of gas commercialization, a lot of things being done around that space, but yet to become naira and kobo that we will understand.
There is provision following the PIA, that's the Petroleum Industry Act that was passed. About 30% of the petroleum tax goes to the frontier basin exploration activities and all of that. And I hope that money, a lot of it can also come to activate gas, because in many of the basins you are looking at, we have gas. We have far more, at least twice more states in Nigeria have gas more than the oil. And then if we begin to devote some of these resources in that particular frontier basins to exploit the gas, then it's going to go and take us a long way. Because if you look at the whole of all the regions that are producing oil are also producing gas. But there are regions from, if you look at Anambra, Imo, Enugu, Kogi, now going up all through the Benue Trough, all those states along the Benue Trough is all full of gas. Gombe, Adamawa, Koputara, they're all full of gas. And that is where, and Nigeria is the biggest gas deposit in the whole of Africa and the 8th in the world. So we need to import in gas. Gas is not as difficult for us as the crude has been. And then, of course, if we start doing oil in the middle belt, that will also help. So we need to get into more investment in gas compression, in gas liquefaction, and then focus on meeting domestic demand. After all, some of the power can be generated with gas. I'm sure most of them are actually being generated by gas. So we will have more gas to give to power. You can have gas-based power generation in the area where the gas is being exploited. So that will diversify the geographical base of our oil and gas resources. So as you are saying, and then gas is the transition program that Nigeria has in meeting our energy commitment, our environment targets. So gas is our transition. So I think we'll on exploiting the gas because it's less volatile than the challenges we are having on the oil, on the crude oil.
I totally agree with you here, Prof. Prof, let's look at purchasing power of Nigerians as we move towards the festivities. Doing my research in 2019, when you convert the minimum wage in dollar rates, above almost $80 to $100. As of today, it's about $40. Even so, it depends on where you're looking at it from. But the issue now is low purchasing power and the festive season. What are you thinking of? It seems like people are not going to be buying as much as they should buy because you definitely have to cut your coat, not according to your size now, I think it's according to your cloth.
Well, people are, well, you have to understand that when the festive season comes, it's not so much about money they have in their pocket, they also borrow money because it is a religious thing, is a cultural thing, is a social thing. If they don't have the money, they could sell their house, they could sell, so they can borrow money from anywhere and everywhere to make sure the debt level will increase, inflation pressure will continue because the prices are extremely high right now. And you can see the inflation figure a few days ago showing them upticking to 21.47, and it's going to go up again before it now starts cooling when the festivities are over. But again, it will be entering into January, February, March when we are going to have shortage of food because we are entering planting seasons as well. So you're going to have a little prolonged hardship, but eventually it will in the near future.
Prof, inflation, which you mentioned, key now, but many say it's fueled by both shocks and policies. And you mentioned flooding, Russia and Ukraine crisis. What if the CBN continues to also jack up this rate after hitting about 500 basis points between May and now, and that continues to be on the high side? Do you think it could rein in inflation anytime soon, or it's just a process that will reap the benefits as we move to the new year?
No, monetary tightening policies alone cannot stem the tide of inflation. It can only contribute to that, but it will not on its own alone, because how many people are in your transmission belt? You know, you have only about 40, 60% of the people that are banked, and then you have this perennial issue we are dealing with now about trying to change the currency because of the infiltration of fake currency and explain all that sort of all those things are causing a rapid change in the currency that we are using now. But having said that, there is a lot of money in circulation without a doubt, and they are being mopped up in the rate by raising the NPR rate to 16.5 is only to address a segment of it, which is those who may want to come and borrow money are discouraged by default by doing so. Those who have already borrowed may have to experience more hardship in paying because obviously the banks will reprice their assets, and then you're going to see all that. But of course, on the foreign side, again, America is already increasing their rates, so which means that even the monies will borrow in dollar. So all of that say that going forward, but it's not going to be intractable. There's a little more hardship.
Prof, before I let you go, let's talk about sustaining policy implementation as we move to the new year. What are these things that needs to be done? I know we've talked about this before, but one that is topical here is saying that can we sustain this present foreign exchange policy that we run as a country, opening up different windows? That is something that analysts have argued. Now, do you think that given that market to play with demand and supply, allowing demand and supply to control that market, do you think we could get some positives other than, you know, limiting it and having the I&E window, having some windows for other forms of businesses, if I'm allowed to use that word?
You see, when people forget that a pricing mechanism, inflation, rates, they're all a product of, we don't have that liberty of how are we going to do this, but we just haven't got. Do you have an import-dependent economy? You have them asking for 4.6 billion what they want to import from China. They're asking for it. And you hear your central bank saying to you that possible, the ones that are allowed to have to be billion a month. And then you also see that the money to disburse is only giving it 300. Now left with diaspora remittance and FDI that is vaporizing away. It's not adding up at all. The crude are high, the going up and down, and that you can't do that revenue coming in as expected. 79% of that forest comes from gas. The remaining 10% and that's what has gone up, remittance to $20 billion foreign portfolio investment that have all. The thing is, if the NNPC is not pushing that CBN, and where would he get the money? So it's a lot of necessity. That is what the circumstance that you have, that we don't have. You have far more people chasing the dollar than the available dollar. If the NNPC stops what they're doing and pushes this $3 billion through CBN, yes, we may have some comfort. But it's not doing it. What it does, it did a direct swap, carrying the crude over to the refiners abroad. What exactly is the volume that is going out? Today, we hear they bought some pipe, they did, you are not sure. And then you now have them in exchange bringing out PMS. Again, you don't know how much PMS you are bringing in. Is it 70 million liters? How much is it? How many of it are going out of the country? You don't know. So you have the opacity of the supply of crude and the opacity of the import of PMS, and both of them are interactive. And then they're now telling you, government, you see, I'm the sole importer and exporter. I've done my arithmetic. You are owing me 500 billion every month. Go and borrow it. And what is it? Another name for it is subsidy. You can't run a country like this. And everybody conveniently will go and blame it on central bank. How can you do that? Central bank doesn't print dollar. It only tries to, when he restricted the access to Forex, eligibility to Forex, he started to lend money to backward integration and get 8 trillion out there to the real sector to produce, to compensate for the restriction. That's why you have 4 million farmers doing 5 million anchor borrowers program, just trying to augment, because you will overwhelm the Ministry of Agriculture if you tell them to go and deal with this on their own. They don't have the resources to deal with that. So they have to bring the private sector, all the banks, and beg them to invest. And these banks are using their money. It's their money and my money and your money that they are using to activate the anchor borrowers and all these FSS and all that. It is our money. Private sector money, but people are just saying, oh, that they're sharing. They're not sharing any money. They are using private sector money to activate the economy, to ensure that they can manage the challenges that we're having. But other players have to play their part. And that is the simple truth of the matter. Others have to play their part. There are more action that you need from the fiscal authorities to complement the monetary policy, because monetary policy alone cannot you are looking at. Neither can it deliver all the lapses of all other authorities.
Well, it's a good way to leave it, Prof. Having some little issues with the audio, but it later came out well. Thank you so much, Professor Ken Ife, for you joining us on the program this Monday. We appreciate you. Do enjoy the rest of your week and compliments of the season.
Thank you, and thank you too.